Broadcasting live. Weekday mornings, this is listener-supported One Radio Network.
Fred Dashevsky is here on Wednesday, the first Wednesday of the month. We took last week off, so Fred is here now on the second Wednesday. He is the head cook and bottle washer guy at U.S. Coin Capital, with an O, with the building capital, and a former partner of our dear friend Andrew Goss, who 3 years ago he left us. And Fred has...
4.
No, is it 4? Wow.
2019.
Wow. See, I missed a whole year. And, of course, we have 15 years of show... Well, let's see, 12 years of shows with Andrew Goss at no cost. And then all the shows since with Fred had no cost on One Radio Network, all the audios and a lot of the videos. So Fred runs a coin company and then does a lot of research. And it's U.S. Coin Capital. And we'll give you the phone number if you want to get some silver and gold and stuff like that. Fred, good morning.
Good morning, Patrick.
You're looking good? You got
Welcome
your American flag on? That's right. You got your American flag and everything. So, Mr. Dashevsky, in the last 2 weeks, the amount of articles, and I don't do TV, Fred, so I don't know, but on the interweb that Al Gore invented, articles with the term De-Dollarization has been everywhere. So my question,
it has been everywhere.
My question to you is this, because you're a smart guy. So if we take the conjecture, that the Dollar Inc. people who we talk about, the boys, either own a lot of the media outlets or sit and meet with a lot of the media people, why would they be running this de-dollarization thing up the flagpole? They got to know what's going on. They got to be part of it because they, like I just said. What do you think? Why would they be doing this?
Well, I don't know that they are dealing with, let's say, control of the media on a day-to-day basis,
You don't think so?
Article to article.
Really?
I don't think it's quite that. I think they've got a broader control over the ownership, let's say, of the large corporations. And we know that the media in America has been consolidated. What was it, 20 years ago? I think there were 1,000 independent outlets, and then it became 200. And what are we down to now? I think there's 7.
Seven or eight corps that own everything, Freddie.
So they effectively own all the newspapers, all the radio stations, all the media outlets, all the television programming is effectively down to about 7 major corporations. My gut feeling is that I don't think they are really controlling the day-to-day news. I think they're sort of dealing with the broader picture stuff. So they're not going to stop an article from coming out or an opinion that's going to be promoted about de-dollarization. But I have said this numerous times that when people tell me that they think the dollar's world's reserve status is coming to an end anytime soon, I still have a hard time with that because effectively I don't believe that Dollar Inc. boys, and since we've talked about this, you know what I'm referring to there. For those that are not familiar with this, we believe that the dollar's entrenchment has been so well established that I don't expect that they're simply going to roll over and let anybody take over the dollar's reserve status, regardless of the news that you hear, regardless of the pushback from other countries. Because when you look at it carefully, people say things about, China is pushing back against the dollar. Well, the reality is that China has about 3% of the world's reserve status, and that's it. I mean, they are.
You're talking about the yuan, or renminbi, whatever the national thing. About 3%, right? Okay.
About 3% of the world's, currency is dealt with in Chinese yuan. So, they are a minor player amongst the larger nations when it comes to this sort of thing. And again, I just don't believe for a minute that the Dollar Inc. boys are simply just going to allow somebody to, after all these 70, 80 years of entrenching the dollar's status, that they're just going to roll over and let somebody kind of push them off to the side and have somebody take over as the world's reserve currency.
Well, it's a fair point, but you have also grown up in this model from day one, and it would be, I would understand where it would be difficult for you to see a change. right? It's kind of like.
Oh no, I'm not having a problem with that at all. In other words, I see the pushback and I see the rationale for the pushback.
Right.
I think I don't know if we've talked about this on our shows or not, but I think we've made political decisions that almost force these kinds of things to happen. We do stupid things
like
politically that aggravate. We start importing, goods and services from around the world, but then we start putting sanctions on trade agreements, or we put sanctions on Russia because we're trying to push back against the political problems that we see that are happening. So Russia invades Ukraine and we fight back by putting sanctions on Russia. How do we not expect that there's going to be pushback, by Russia against the US dollar?
Yeah, they had.
So in other words, my point being, I think we're causing the problem as much as we are not intending to.
Right. That was what my original idea was. Why would they be causing the problem? Because the dollar-ink people have to control Biden on some level. They at least control the Fed, and Yellen, she's all in.
Yeah. I think in a lot of cases we're dealing with after-the-fact problems. I think they do things to solve their political problems first. Then we get a kind of a result that they may or may not have anticipated, or how far it would go. Maybe they were thinking, okay, we're going to put these sanctions on Russia and that's it. It's just going to be quiet. They'll accept it. They'll roll over without a pushback. Well, no, that's not what happened. So Russia decides not only are they going to try to push back, but they're going to try to align other countries to come with them.
Which they are.
And go
Iran,
to China and say, hey,
China, Iran,
let's get together and push back against these bad Western bankers and bad Western guys, and let's see if we can create our own environment. And they may make some headway in that regard. And then we now have the boys saying, well, okay, if this is what's going to occur, we have to address that problem. But I think you and I know that there is no way that we just simply watch this evolve without some significant pushback coming from the boys, even if that means finding a pretense for war against these countries, because I believe we would do that to support the U.S. dollar's world reserve status.
Which they did, of course, in Iraq and Libya and other places, right? I mean, that's
not unprecedented.
That's on the record.
All they have to do is come up with some political excuse, and in these modern days, honestly, how hard would that be to come up with an excuse to invade whomever is pushing back against the dollar? So now I do see that the dollar's status is being chipped away a little bit here and there over the years. So little by little, we aggravate people, we keep this control, and a lot of countries are saying, well, why do we have to be locked into this? I understand what our rationale was initially, but we don't like it anymore, and perhaps we'd like a little more independence. So they try to make some efforts to push back. And, the things like the BRICS that have come up that people are talking about, and other efforts made by some of the foreign countries. I just, again, don't see that it changes rapidly the status of the U.S. dollar's world reserve currency status. It may happen over a period of time that little by little, it may not account for as much percentage-wise as it does. But I think it's going to be a very long time before we ever see a point at which the U.S. dollar does not stand as the world's reserve currency, not only because the boys are so well entrenched, but there is also the other side of this, which is how much do people really trust Russia and or China? There is a lot of fear when people look at the Chinese currency because the government there doesn't tell us everything up front. They're not obligated like we are to be as, open about their economics as we are in the U.S. and in the West. So there are a lot of countries that are concerned about whether China's telling the truth. And if they're not, how can we trust their currency and what they're telling us about their currency? So it's not going to be so simple.
Quite a few stories about how much China really has, that they allegedly have a whole other fund that rich people in China put their gold into. So they don't tell us, even though, they don't tell us how much gold they really have, and nobody knows.
No, but speaking of gold, so here's an interesting thing. The central banks around the world have bought more gold in the last 24 months than any time in the world history.
I saw that. 24 months more, man.
More than any time in history.
Well, they know what's coming.
The quantities of gold that the central banks have been buying has exploded. Russia has literally purchased, I want to say it was 1 million ounces of gold, forgive me. 31 tons of gold have been purchased by Russia in the last 24 months.
31 tons. That's a lot of gold.
Tons. Yes, that's 1 million ounces of gold.
Well, let me ask you.
$2 million worth.
I don't want to get too far afield, but it's interesting. I've been following it too. So you say in the last 24 months, all the central banks have bought more gold than they've ever had in the history of ever.
Yeah.
Where does all this gold come from? I mean, if I'm Russia and I say, okay, George, go out and buy 30 tons or whatever, who do they buy it from?
Well, they either buy it from other central banks who are willing to sell off some of their own reserves, or they have to go directly to the mining companies and purchase it directly from the manufacturer, if you will, of the gold directly. What's interesting to me, though, is looking at this is not just Russia who's done this.
Everybody.
It's all the central banks. So just about every central bank on Earth has been accumulating more gold in the last year or two. And what I question is, if they believe that their currency was going to be stronger 6 months or a year from now, they would not be buying gold with their dollars or whatever their currency is today. In other words, they would expect their currency to be stronger in a year. They would wait, allow the currency to get stronger, then use that currency to buy more gold later on. They're not doing that, which tells me that I'm getting a little suspicious here, but it seems to me that if you draw this out, why would they be buying so much gold now with their own currencies unless they expect their currency value to go down going forward?
I see. Oh,
and they're protecting themselves by buying gold today.
Or it could be, too, that if they feel like gold is going to be a lot more scarce, it's over 2,000 now, and it's going to be costing more. If prices are going up, there's a natural tendency to buy now. I mean, that's
sure.
That's.
But it seems to me that it's a balance between, if you think your currency is going to be much stronger in a year, it'll outpace the growth in the price of gold. You would wait. But if you don't have confidence in your currency, you're going to say to yourself, hey, let me get rid of all this money and paper I've got and buy that physical gold now, because I think it's going to cost me more to buy that gold in the future. There are a couple of traders, and again, I don't put a lot of credence in the guys that do charts, because charts to me are always they're always after the fact information. You sort of are looking backward and then trying to make a conclusion based upon what's already happening. But the chart guys are saying that we may be in a new trading level where this may be the new bottom for gold.
And
we may be now setting a point at which, the 1900 now becomes the floor, the $2,000 level. And then from there, we start seeing a trading range between 2,000 and let's say 2,500. There are a number of very smart guys lining up on that side of the economics. And I find that very interesting, because a lot of times you would think once you hit this $2,000 mark, first time it's been here in a couple of years, only the second or third time in history, there has been some profit taking, but it hasn't slowed down kind of increasing pace. It's amazing.
A fellow that we have on from time to time, I like him a lot, is Tom Luongo, Gold, Goats, and Guns. And he's a chart guy, and he's making that argument right now. He's very bullish now, and he says that this is going to be the bottom. Of course, you never know. I mean, things.
You never know. But a lot of times these guys have, historically been able to find things, charting them out that do and turned out to be accurate. I just find it a lot of future prediction going on when you do that sort of thing. So there are too many variables. A good example, the last time you and I had a podcast together, there hadn't even been a banking crisis situation yet.
Yeah. Oh, that's right.
So look at how much has happened in the past 3 or 4 weeks.
We need to talk about that, yeah.
Where that situation wasn't even on the table at the time. There was nothing about that at all. And we keep talking about that these exogenous events come out of left field that we can't predict, that alter the economy. And I keep saying the size of these things now have been so big that every time one comes up, it's massively effective. And look at what this did. I think there's a couple of things I took from this. The first one that I found almost humorous was how much effort the banks spent the past decade trying to convince everybody to go to mobile apps. They were all pushing on it to everybody, right? Use the mobile app, get your banking app, get it on your phone, all that wonderful convenience of having the mobile app on your phone. I don't think the bankers thought this through, that in a panic situation, that people would swipe $100 million out of their checking accounts in a matter of seconds the moment they woke up in the middle of the night and found out that there had been a bank failure. The banks were totally unprepared for this. So when Silicon Valley Bank went under, by the next day, there had been hundreds of millions of dollars withdrawn from U.S. checking accounts and savings accounts instantly because people picked up their phone, heard about a bank failure.
You could do it that quick. I guess you could do it that quickly, huh? Just
instantly.
Boom. Transfer it anywhere you want?
Yeah, just let's say either to another bank you thought was safer, or just simply draw it out and take hold of it so that you could figure out what to do, because people were worried that this was a systemic problem.
But you can't take $1 million of cash out in moment's notice. They won't give it to you.
Not in cash, but you can transfer it from one account to another.
Oh, to another bank, one of the big banks.
Sure.
Or something, whatever.
Yeah, or even put it into a money market
account. Or even
account,
cryptos or whatever, yeah.
Whatever you wanted to do with it. Buy gold with it, which a lot of people chose to do, or simply move it to one of the larger banking institutions. So some of the big banks actually benefited tremendously from this banking crisis, because they ended up getting hundreds and hundreds of millions of dollars of new money, because a lot of people were afraid of these little banks that had gone under. The other thing is, I wanted to make clear from the very beginning, from the first time I heard about Silicon Valley and everything that's happened subsequently, I did not believe, nor do I now, that this was a systemic banking issue like 2008. 2008 was a crisis that crossed the entire banking system. Mm-hmm. It wasn't just limited to a handful of banks. It affected everything. We were on the brink of a complete economic disaster that we thwarted by putting up that $900 billion in TARP overnight, the emergency meeting we had between the Fed, the Treasury, and the big banks to solve that problem. When Silicon Valley went under, by the next morning, there was an emergency meeting between the FDIC, which was guaranteeing deposits up to $250,000, but the Treasury, the FDIC, and the government decided immediately they were going to insure accounts over $250,000, even though the FDIC had no liability to do that, simply because they didn't want the public to panic. And they saw that if this was going to be the beginning of a problem, that if multiple banks were going to fail, what you didn't want to happen was this overnight kind of national panic of people saying, "Oh my God, the banking
Jimmy Stewart moment, right? Jimmy Stewart moment.
Yeah, let's just get our money and run," and everybody starts withdrawing their capital. So to stem the flow of money out of the banks, the Treasury and the FDIC got together immediately and said, "We will insure all accounts, no matter how big they are." Even though the FDIC was only supposed to guarantee up to $250, they went beyond that.
Where does that money come from? The FDIC doesn't have. Yeah, well, okay. I mean, they're going to create that money on a computer somewhere. That's where it's going to come from.
I had that in my other pocket. It was in my other pocket. Yeah.
I'm ahead of you.
So, the FDIC has an insurance program. They've existed since the Great Depression, and that was their purpose, was to provide a backstop. So if there were bank failures like we saw in the Great Depression, the idea was to keep it from becoming systemic, and that they would at least let the public know that, hey, your deposits are guaranteed. Now, what people did, moving money, for example, to mutual funds, which you could do, again, with a swipe. Most people don't know mutual funds are not guaranteed by the government. They are not FDIC insured. So those funds stand at a lot more risk. But that having been the case, the Treasury Department certainly stepped up, and the FDIC certainly stepped up and said, we want to make sure the public is confident that whatever happens with these individual banks, it's not going to, cross over to the entire banking system. And that turned out to be the case.
So let me see if I'm clear then. The millionaires, supposedly a lot of the Hollywood people and who had millions in SVB, they didn't lose it?
Nope, didn't lose a cent.
Somebody created it from somewhere, unless they had it in
their account. And what they're going to have to do now, they'll have to turn to the banks and ask them for more money, because the banks all contribute to the FDIC. That's where their funds come from, right? It's the insurance policy. So each bank has to put up a certain percentage of their assets. They'll probably be asked to increase those percentages to secure the whole system inevitably.
Are they claiming they had enough money in the FDIC coffers to cover SVB, or do we know?
Yes. Well, they were able to do that, and then by the second or third bank failure, what ended up happening is that the big banks, J.P. Morgan, Morgan Stanley, Citicorp, they all got together. They chipped in to bail out the next two. They put up about $5 billion each and just said they believe so strongly in the U.S. banking system that they were going to put up their own capital.
Yeah, I believe that.
And what they ended up doing is they ended up buying out these banks. They just absorbed them.
And isn't that where it's going? I mean, there was a lot of chatter about the insurance with Yellen, and she was very noncommittal. And I believe it stands like this today, you tell me the community banks, the Bank of Dripping Springs or whatever, there's still just a $250,000 deal for Patrick if I've got $300,000 and the bank burns, whatever. But at the big banks, there's unlimited insurance. Is that true?
It is true, but I don't think they would allow it to happen to where you would lose $1 if your little local bank were to go under, only because I don't think they want people to panic. So I think they're going to make good, because here's what they've done now. They've set a precedent. They allow people that had more money in one bank to be covered.
Right.
What are they going to do then? Turn around to you and go, sorry, we don't like you as much as we like them, so therefore we're not covering you, but we were willing to cover them. That's not going to fly. So they've set themselves up now as a precedent to have to follow through, that if there are further bank failures, which, Jamie Dimon thinks there are going to be, and so does Warren Buffett, although I'm not really sure where their concern is coming from, because if you isolate what happened, for example, looking at Silicon Valley, this was not a smart application of capital on their part, right? They took all the deposits that they gained, which they got, for example, by paying higher interest than anybody else. Mm-hmm. They wanted to bring in all this new money,
right?
All this fresh capital,
tech money, tech money,
all the tech capital, right? So how did they do that? Well, they paid more in interest payments on deposits than anybody else did, so that they could draw in all this new capital. What they didn't count on was that the Fed was going to aggressively start raising interest rates.
Right.
So what they did with all that capital they took in, they bought a bunch of bonds. But they did this almost 2 years ago when the bonds were paying about 1.5% return. So then the yields went up because the Fed raised rates several times, 4 or 5 times in a row. Now the current bonds are paying twice as much, 3.5%.
So the bonds they have are worth a lot less.
A lot less. And then what happens is you get this overnight redemption because people start swiping their mobile phone device because they panicked when they heard the bank was failing. They withdraw all this money. So the bank is losing capital, hundreds of millions of dollars being drawn out instantly. So now they have their assets to try to raise money to solve their economic disaster problem. But the problem is they're holding bonds that are paying 1.5%. When they try to sell them in the open market, everybody snored. Everybody looked at it and said, well, why would I buy your bond at 1.5%? I could go buy a new one from the Treasury today that pays 3.5%.
Or I'll give you 60 cents on the dollar, 6 cents, whatever.
Exactly.
Right.
So they couldn't raise the capital anywhere fast enough. And that's why they went bankrupt.
But why? Wouldn't they be smart enough? I mean, there were people predicting rate hikes were coming. A lot of people.
And rate hikes came. Yet they did nothing.
But why would they? I don't know.
Well, therein lies the problem. Why would they not have addressed this problem?
Exactly.
You should have figured, after watching, for example, the biggest disaster in that realm, Orange County, California, we saw this happen when they had a bond portfolio that was so huge. And when the bond market went against them because rates were climbing and they didn't adjust accordingly, they got stuck with a massive bond portfolio they could not liquidate. And it caused a massive disaster. It bankrupted the entire county. You would think, after having seen that these banks would have learned the lesson that when interest rates are climbing, the last asset you want to be holding are Treasury bonds with low yields. So not only did Silicon Valley have Treasury bonds with low yields, 90% of the assets that bank held were in those types of debt assets, those types of treasuries. So that's what put them under.
Well, this maybe harkens to a lot of people are arguing out there that the banks are all kind of in it together, the boys, and all the banks, and they want to turn this thing into a third world whatever because they want to do a central bank digital currency. That'll be their Hegelian dialectic. It's possible.
Well, it certainly it is easy to see that and easy to make that case. Every time something happens, people utilize that as a way of supporting that argument.
Sure.
This is another step toward or another excuse to, and again, it's easy to do that. I kind of parse between those things to say you can't necessarily take every event and support these positions because it's not really correct.
Well, people who are making the argument, you get why they do this, right? Sure.
Absolutely get it. Absolutely get it.
They do it.
Easy enough to create support for that argument when you have these kinds of things happening, because other than that, you have to accept the idea that these bankers were that ignorant to not recognize the flaw in what they were doing in a rising interest rate environment, to have 90% of your assets in low yielding bonds that become worth less when interest rates are going up. It's either that they never anticipated this rapid withdrawal of capital, or they thought that the Fed rate hikes would stop and maybe they would start lowering them again as the recession problem kicked in, and they were just trying to ride it out, and they just timed it badly. But I think that was a dangerous game to play.
I think so.
You know, it's fine if you're an individual investor and you're sitting on some treasury bonds with low yields.
You could hold on to them.
Yields go up and, you know, you've got other assets. And so, all right, you'll get less for those bonds. But when you're a banking institution and you're supporting the value of all the depositors in your bank with your assets, and your assets are comprised of things that are becoming worth less and less every month, and there doesn't seem to be any end to the Fed's rate hikes. I mean, okay, CPI came out today. It was a little softer. So now, according to their numbers, we're at about a 7% or so rate of inflation annually. Still too high for the Fed, which means they still want to keep rates climbing. This is not ending anytime soon. So this was just bad management on the part of the banks.
An article out this morning on Zero Hedge, one of my haunts, French President Macron message of building strategic autonomy away from the United States when he had a little mini 3-day meeting with Xi. So he's now talking down the dollar in the United States as well. Macron.
Yeah,
of course he's a globalist.
Involved with the euro.
Yeah,
I mean,
he's a globalist.
I don't. Yeah, I just don't see this happening without a pushback, and we haven't even seen any efforts by dollar boys to push back against anything, because I don't think anything significant yet has occurred. But I think they are aware of what's happening, and I'm sure that there is a plan on the books that if things get too far down that line, away from the U.S. dollar, there will be a significant pushback of some sort or another, whether it's political, military, or whether it's just economic. You know, they will find a way to sustain the dollar's reserve status. I just don't think it's going to fade away.
Saudi Arabia spent a lot of time trashing the dollar, lots. And they met with Xi and kind of just Biden. And Iraq now is off Iraq is off the dollar peg. They are off as of the last 2 or 3, 4 weeks. So they're going with their little dinar thing or whatever that's worth. So there are people doing it, but I suspect your argument, if there's 40 trillion or so, we don't even know the number, do we, of dollars out there circling around the world, Earth, it'd be a big step to take this guy down, this big dollar down, right? It would.
Yeah, it would. Yeah. It would require changing so many things. So the structure of all the payments that are currently in existence would have to change. All the payments made on existing debts would have to change. Everybody around the world that stockpiles dollars, stockpiles U.S. treasuries, all these things would have to be fundamentally changed, that they would accept now another form of currency payment. It's just not something that's going to be logistically very easy to accomplish, even if the decision were made completely today to say, okay, that's it. The dollar's reserve status is over, and we're going to allow every other currency to float on its own, and whoever rises to the top, great, you take over. Even if we wanted that to happen like that, it just isn't something that logistically can happen very quickly. It would require, I just think it would take years to make those structural changes. So what I hear you saying
is that the dollar losing its reserve currency is not out of your stratosphere of possibilities, but if so, it's going to be a long time. 5, 10 years.
A long, slow, inevitable stretch, chipped away at it little by little, as opposed to, let's say, an overnight. Like, people are coming up with dates all the time. You know, it's supposed to happen last year, 2 years ago, and next June, and this. Everybody's got a date where this is going to happen. Like somebody's going to flip a switch. I just don't believe it's going to be like that. If it happens at all, it's going to happen over a very extended period of time, little by little. But in the meantime, I think it's very interesting to see that the world's banking systems, all the central banks, seem to already decided that whatever happens going forward, they all believe all their currencies are going to get weaker, and they're all loading up on that physical gold as wealth protection. This is part of what's been driving the price higher. Plus, of course, the dollar now, it keeps tapping that 101 on the dollar index. Remember, that peak was 115 back in November.
Yeah, wow.
And gold was $1,650 an ounce, and silver was $18.60. So today you've got silver at over $25 an ounce.
25,
and you've got gold at 2020.
Is it 2020?
Yeah.
Wow.
It was this morning. I haven't looked in about an hour, but.
Yeah. Silver 25.
And the futures market and the metals have caught up. There was a gap there for a while, but the physical side of the spot price of gold has actually caught up to the futures market. And that kind of indicates that there's real solid support. So I think the chart guys, who are suggesting that we may be at a point where this is the new low, they may be right.
Sure like to see that silver get back up to $50 for a while, just for fun, just because it was so cool.
That would be fun.
When was that?
Well, it's happened a couple times. We had a blurb a few years back, right after 2012. There was a little spike. And then, of course, we've had a couple of times where it's crossed that mark and always been short-term, real fluctuations, drove it up real quickly, and then it would completely fall back down within a matter of weeks. So I'd like to see it sustained at 25, 30, 30, climb like that more slowly, because I think that adds support to it rather than, let's say, it just jumps overnight to $40 or $50 on the back of some news, because then it's going to be subject to a quick fallback as well. Anytime any market goes up that fast, you're going to have profit takers, so you're going to get volatility.
Mm-hmm. Our phone lines are still out, and they claim any day now. Boy, it's been a while. So email if you have a question or comment for Fred Dashevsky this morning, as we're live here April 12. Patrick at OneRadioNetwork.com. Patrick at OneRadioNetwork.com. Fred Dashevsky, he buys and sells gold coins for a living. That's what he does. We try to get him to play golf, but he doesn't do it. He just buys and sells gold coins for a living. Here's his company here, 800-878-2646. So, Fred, what have you seen in the last month since we've talked as far as prices for what you sell, the numismatics that are graded by third party, and also the currency silver? What have you seen price-wise?
Considerable increases in the past 6 weeks. Wow. That we're fairly flat from January and February. All of a sudden, just exploded. So there was a point, I think, beginning of March. So literally, let's call it, 4 or 5 weeks ago.
Right.
Things like $20 gold pieces were running in the $2,500 price range. They're now $3,100 a coin.
Really?
So that's a pretty big price jump within a 5 or 6 week period. Again, there are times at which I was really hot on the idea that gold seemed to me to be underpriced and coin values seemed to be a little bit lower than they should have been given the state of the economic environment. And sure enough, we did get that response. So we have had pretty big price jumps in the past few weeks. And I think that's going to be a continued trend because demand is absolutely outrageous. It just opened up like floodgates in March and has continued right through April to roll right through that period where lots of money is coming to us from all sorts of places, all sorts of people in large and larger volumes, because a lot more people are beginning to grasp the nature of the problems with banking systems overall and the value of paper money overall, to the point where, we've talked about how the sustaining value of the dollar, in my opinion, is based so much on psychology more than fundamentals. I think it's how people perceive the dollar more than its actual relative strength. And that perception is subject to change very rapidly, which we obviously could see. Look how the response was when we had a few bank failures, how quickly people responded. I mean, it was instantaneous reaction. So I think the value of the dollar is subject to an awful lot of change. And I still think if we crack 100 on that index, if it goes below that, I mean, we could see a free falling dollar.
Really? And it would just be loss of confidence and people getting out of the dollar, and that drives the U.S. dollar index down?
Yep. Drives gold prices higher, drives all the cryptos would probably benefit as well. People are looking for alternatives. And, why are they looking for alternatives? It's because they're not confident that the U.S. dollar status is going to stay the same. I mean, we had a fundamental problem before the banking system problems that occurred in the last 5 weeks, when we were looking at the size of the debt and the interest payments on the debt obligations the government has, and how much they're bleeding money. You got a government spending $1.5 trillion more a year than they bring in. They're paying $1.5 trillion a year in interest payments on their debt. There's no end in sight. You've got a Federal Reserve Bank that seems to be way behind the curve, waited way too long to address the financial problems, and the way they've addressed it creates real fundamental issues that I don't think they really fully anticipated. I think it's almost like a doctor doing diagnosis. We think we know what the answer is, so we're going to try this. And if it works, then we're probably right. If it doesn't, then we'll go back to the drawing board and say, well, I guess we were wrong about what we thought the problem was. And I think the Fed is like that. They make a move and then hope to see whether or not what they did has the correct response in the overall environment. If it doesn't, they go back to the drawing board and say, well, that didn't work. Maybe we ought to try something else. So their effort now is just keep raising interest rates because inflation is absolutely resistant to this interest rate climb to date. Although we've seen a little slowing down in the ISM, we've seen slowing down in the economy a little bit, it still hasn't had the impact the Fed wants. So they will continue to want to raise rates. But they're going to get to a point where they're going to shoot themselves in the foot. They're going to cause a recession. We still have an inverted yield curve. The likelihood of recession is still extremely strong. And the Fed's only response to recession is to lower rates. So we're going to raise rates to fight inflation. We're going to raise rates to fight inflation. Then we're going to turn around and lower them right back down
during the recession.
As soon as the economy slows down too much because we overdid it.
I thought their job was to not have these booms and busts, isn't what they argued when they created the Fed in 1913, right?
They're just doing it poorly.
You think?
They're doing it poorly. And they're creating bubbles all the time by doing this stuff too. So they create real problems with the economy because they sustain the wrong environment for too long. So when rates are going up for too long, too far, too fast, it creates its own problems. If they lower them too quickly or not enough, they create their own problems. There is no simple answer anymore. And, you know, unfortunately, as I've said before, we're past the political area where we can make political decisions to resolve this. We're down to economic decisions, but there is no simple answer because the fundamental problem simply won't go away. You're creating money that is unbacked, and you've been doing this for years at an ever-increasing pace. You can't simply just make that go away by a couple of rate changes. It's just not effective enough. Mm-hmm. So we're going to be experiencing this problem of a weaker dollar going forward for quite a long time to come. And I would anticipate that people who are holding money right now, they're seeing it. Anecdotally, they're seeing it firsthand. They know the dollar's buying less. Regardless of what the government tells us, people know how much food costs are going up and how much labor costs are going up and how difficult it is to buy any kind of commodity or physical asset without paying a hell of a lot more than you did a year or two ago. And I don't think that trend's going to stop anytime soon. So I think the Fed is screwed.
Eli is in San Diego. That takes a lot of courage just being out there. And so is there a way, Fred, that I can find out if my funds in a smaller bank I have over 250 are insured rather than just suppose that they would be taken care of as you conjectured?
Well, I'm telling you, they're not insured.
They're not insured.
However,
okay.
They're not. FDIC has a 250 max. That's the cap. However, I believe at this point what's going to happen is if there are a couple more banks that fail, that they are not going to allow people to lose any money simply because I don't think they want this to cascade and create a bank run. You know, they don't want people to lose that confidence. So I think by default, they would cover accounts over 250. Now, they're not obligated to, but like I said earlier, they've set a precedent by having done this with the first few bank failures that have occurred. I find it hard to believe that they would then turn around to this person's bank and say, sorry, we've decided that we were willing to cover these people, but not you. I think that precedent has been set. So I think they will probably follow through. If that bank should fail, they would cover the additional, especially at this point in the game, because they don't want this to spread to, you know, just imagine what happens if this becomes a systemic lack of confidence in the general public. Everybody who's got money in their account.
It's not a done deal, though. He still needs to be cautious because it may not. You may be incorrect on that, right?
Yes, they may not support it, but I think that they have no legal obligation to, and they could easily make the argument that what we've said is what we're going to do. We guarantee up to 250. If you were willing to risk more money in a single account beyond that, you took that risk. You're going to have to absorb that loss. Again, that obligation is not locked in. So there's no guarantee that they would cover anything above 250. I'm speculating, and I want to be clear about that, that I do believe that the Treasury and the banking industry at this moment in time would probably support accounts above that simply because they don't want everybody to turn around and be fearful that their money is going to be gone out of their banking accounts overnight.
What is the federal funds right now? Is it close to 5%? 4?
5.5.
5.5. That's the percentage. That's a percentage that the banks pay to borrow money, correct? And that
yeah, and the Fed can, the Fed can alter these things by paying more on the Fed deposits. So, if the overnight window pays more, then they can encourage banks to leave more money with the Fed. If they want to lower that, they can reduce the Fed funds rate. But what's happening, of course, according to a lot of people I've talked to, especially in the real estate business, is that borrowing money is also becoming a lot more difficult, regardless of the rates, that it is getting a little bit more difficult to get banks to be willing loaners now, because again, they're finding themselves with a little bit concern of how much assets they need to hold in the event that something else happens that may require that they have liquidity. So, First Federal, that bank went under because of mortgage problems, more than the other banks that went down, which were more related to either crypto deposits, which had a problem because FTX, when Bank Friedman went down, right? So FTX was a crypto exchange. When it faltered, everything tied to crypto suddenly became suspicious, and a lot of banks that were heavily involved with the crypto people suddenly got a lot of redemptions because people were worried that this FTX failure might lead to a lot of people withdrawing from those crypto bank funds. So the next thing you know, the banks tied to the cryptos went down, and the banks tied to these tech companies that were tech startups that have been heavy investors suddenly also became somewhat suspicious. So this is why I think that this banking problem is a little more isolated than a 2008 kind of problem that was, again, systemic across the entire banking system. This, to me, is more isolated. So there may be another couple of banks that do fail as a result of what's happening recently. I don't think this is going to spread across the entire banking system, so I don't think people need to be concerned about that. But it's very interesting to see, like I said, how quickly the confidence arose. And I really do believe the banks shot themselves in the foot by having encouraged everybody to move to mobile apps without thinking how rapidly these redemptions would occur in the event that people sort of woke up in the morning and said, hey, wait, I don't know what's happening here. Or maybe I should just swipe left and take my millions, get it out,
well,
just put it somewhere else.
2023, I mean, you saw what happened with the SVB thing. I mean, Twitter, Facebook, I mean, all of the social media, they were all over this thing, man. It just was like wildfire.
It didn't take long for it to spread, right? Now, remember, it wasn't too long ago. You don't have to go back more than 5 years, 10 years at the most, but 5 years even, where if you wanted to withdraw a large amount from your bank, it meant a trip to the bank. You went down, you sat in front of the banker and said, hey, I want to take this money out of my account. I want to move it. And there was a time lag. They had time to soften the blow. They had time maybe even to talk you out of it, because you would sit there in front of the banker for a while they did all this, transferring. You had to sign forms and fill out this and do that in order to move your own money. Again, I think the advent of mobile apps kind of backfired on the banks. I think they wanted everybody to have that convenience, because I think their thought was that if you have your banking app on your phone, the chances are you'll probably make a lot more transactions. And of course, they benefit profit-wise from everything they make. They make a little money on every transaction. So if they can encourage you to do 5 times as many transactions because of the convenience of having this on your phone, well, they're going to benefit from that. I don't think they anticipated the other side of that, which is if you suddenly got fearful of the status of the bank, that you just might wipe all your money right out of there instantly. And that's what they experienced. They've never seen redemptions at this level so rapidly hit the banking system overnight, and they weren't prepared for it.
And so is an app it's the same thing as going online to chase.com to your account and transferring. It's just more quickly when you got the little phone there as you're driving to work, right?
Right. And you can go online with your phone. Right. So it's effectively the same thing. So, again, I'm drawing the distinction between, again, the old days where you literally had to go to the bank to do this type of thing, where nowadays it's, it's a mobile app. It's a tap onto your laptop and just withdraw the funds, just move it. And the banks have definitely faced the advent, foisted by their own petard, as they say.
Here's an email from Susan. What's the difference between liquidating my 401k and buying gold and silver, or putting gold and silver into my 401k? Is that possible? from Susan.
Okay, so in order to put money into a 401k, most of them don't allow you to do that with physical gold or silver. So the only thing available to you would be either, you could buy mining shares, you could buy options, you could buy ETFs, which are probably the most straightforward way of doing it. But you generally can't take physical possession within a 401k. The IRA accounts, they do allow for physical gold and silver, but again, it doesn't go into the point where the possession is in the hands of the investor. You have to have your IRA account with a bank that would hold gold for you. And several banks are set up to do that. So you move your IRA account to that banking institution. You then direct them to use some of the funds in your IRA. They buy gold for you, which, by the way, can only be in one form: American gold or silver eagles. That's it. It's the only form you can buy. Then those gold coins are shipped to the banking institution, which holds them in their safety deposit and keeps them safe for you and gives you an accounting of the gold or silver that you've purchased, which at some point you could then either sell or at your retirement ask them to ship it to you at your redemption point. So if you took the money out of your 401k directly, you may have to pay penalties or, because you may not be of the age where that's allowed. But if you are, and even if you're not, you pay whatever penalties are necessary. You pay the taxes accordingly. But then with those funds in hand, you can own the physical gold or silver coins that you buy and have the choice of any gold or silver.
Yeah, in your possession. Yeah.
Yeah, and you can have any form you want, not just American gold or silver eagles. You can buy any kinds of gold coins you want. So the fundamental difference is whether you have it in your hands or whether you are leaving it with a third party and hoping that they sustain the account correctly and that they do the right thing when it comes down to you wanting to require that they liquidate this at the end, that they've actually done what they're supposed to do. So far, I haven't heard any real negative stories. I've heard a couple quirky things, like somebody bought some silver eagles at one particular year. I forget, I want to say it was, 88, 89. Anyway, there was one year where it turned out the mint produced a lot less of these silver eagles. And they turned out to have a higher premium value than the other dated ones. And when this person asked to get his silver eagles, he expected to get that date. And they informed him they're not obligated to do that. They're only obligated to give him the number of silver eagles that he purchased, not a specific date. So he lost out on all of that benefit of having bought that year with that rarer date because the bank wasn't obligated.
But silver eagles aren't real American money. I mean, I thought they were just bulk silver, right?
They are bulk bullion, as the gold
so
coins are.
So what does the date matter, Fred? What does it matter what date it is?
Well, the date matters in some respect to some of the collectors who do pay attention to how many they make. And sometimes with the gold coins, there are different sizes. And in 1 or 2 years, that maybe they only made a few of the quarter ounce and made more of the tenth and the half ounce sizes. So there are a couple of dates that tended to turn out to have, a little more value than other dates. And again, all I'm saying is that outside of those kind of things where the banks are saying we're not obligated to support any specific date, the process seems to have been working well for people who chose to have these golden IRA accounts where gold and silver are purchased but not held by the respective customers.
So if someone goes to the mint and wants to buy a silver eagle today, do you know what they have to pay for those?
Their premiums are huge. The last time I looked, they were about $12 over the spot price of silver. So like 50% more than the silver price was the last time I looked at them.
50%. So it would be like close to
$37 for a silver eagle.
And that's almost an ounce of silver?
It is an ounce of silver.
And what silver coins that you sell are the biggest silver content? Silver dollars, the old ones?
Half dollars, quarters, and dimes are the closest to melt, and the premiums are pretty close to what they are on these silver eagles, if not even a little less, even though the premiums have gone up quite a bit. So I think they're a better value overall. You're getting more silver, and you're getting something where the supply is already fixed, whereas with the silver eagles, with those exceptional dates notwithstanding, they're all the same. One from 87 is the same as one from 2017. So, it's irrelevant. And again, they can keep cranking out more of them, so the supply of them is not limited or fixed. So the premiums on dimes and quarters and halves has settled, but it did go up quite a bit from the lows we saw at the beginning of the year, where, again, I had pointed out, I thought those premiums were looking extremely low, and I couldn't believe that we were able to get coins at those prices. And then within a matter of no time, that evaporated and the premiums, just skyrocketed.
This is what you call currency silver, right? Currency silver. Some
silver.
People call them junk silver. I don't like that terms. I mean, what's junky about pure silver?
Well, the junk silver reference is for any of those circulated coins that are of the lowest possible quality. So if you get like a quarter and you can't even read the date anymore, and there's you can't even see Washington's head, the eagle's worn out on the back, you could see it's a round shaped coin. Maybe you could tell it's a quarter, probably can't even read the date anymore. That's the junk silver quality. Okay. The ones I work with, we call coin silver, are above that quality because I want the dates in there still to be some what we call meat left on the bone, so the dates are still visible. You can still tell what they are in the event that somebody wants a particular date, and that may happen in the future, that some dates are worth more than others. At least we have that opportunity,
So that's what you prefer to sell. You don't sell the rubbed out date things.
I stay away from the lower quality junk. It just because the difference is pennies. Literally, it's just a few cents, and I can get off the bottom of the barrel and get the coins of better quality. Mm-hmm. Some things have happened. Like we used to include a lot of the Walking Liberty half dollars from the 1940s and a lot of the Franklins from the 1950s in the mix of silver half dollars. That's getting harder to do. And those coins now have separated themselves. If I wanted to actually go out and get a full, let's call it a full bag of silver half dollars that were all Walking Liberty halves, I have to pay a lot more than for the 1964 Kennedys. If I wanted to get a full bag exclusively of Franklins, I have to pay a lot more for that than just for the regular 1964 Kennedys. So, the fact that you can read the date may become more important as time marches on. I don't want to dismiss that by saving a nickel today. Mm-hmm. It just doesn't seem to me to make any sense. So we try to deal with better quality coins. And people call me every once in a while who buy bags, thousands of coins, and they look, hey, I found this, this half dollar. It looks like it's worth, but okay. It was in that bag. I'm not going to go through 1,000 coins to find the one that's worth $1 more. I'm going to leave that stuff in the mixed bags that we sell. So people tend to get a little better value by us staying off the bottom of the barrel and moving off the bottom of the junk pile.
Here's an email from Randy in Chicago. Thanks for having Fred on once a month. Well, yeah, we do it once a month. Does he see that some of these really expensive coins, like worth $10,000 or $20,000, go up in value as the price of gold goes up? That's a good question. Do they go up? Yep. Does it go up? So say I got a coin that I paid $20,000 for, which is easy to do depending on what you can find, right? Would that be going up as gold goes to 2,000? Would this coin that I have be worth more today than 2 years ago?
Well, the chances are it is, but not because the price of gold went up, but it's because of what caused the price of gold to go up. So the value of a rare coin, let's say you have a $20,000 gold coin. Mm-hmm. It doesn't have $20,000 worth of gold in it.
No.
Okay. We've had little gold dollars, and a dollar gold coin is about the size of a dime.
I've seen those.
In fact, slightly smaller. So imagine how tiny that is. It has 1/10 of an ounce of gold in it. So literally a couple $100 worth of melt value, and there are gold dollars that are worth $200,000 or $300,000 because
some little gold.
Rare.
That's how rare they are.
The size is irrelevant to rarity.
And people are willing to pay $200,000 or $300,000
constantly. They do because they're not looking at the size; they're looking at the rarity.
Yeah. Wow.
So, why a coin like that goes up in value is more about supply-demand characteristics, and what drives since the supply is fixed. What drives the demand are a lot of times the same kind of variables that make gold prices go up, which is higher inflation, weaker dollar, more expectation of inflation in the future is going to cause people to take more capital and move them into physical assets. That's what will improve the prices of those rarer coins more necessarily than the intrinsic price of gold going up, because obviously if a coin is worth, even $20,000 that has $200 worth of gold in it, if the price of gold moves up $100 an ounce, it effectively has changed nothing in terms of the value of that coin's gold content, but it has had some response to its price because what's driving the price of gold going up is the same variables that drive the price of those rare coins. We keep setting records every time there are new auctions for coins that cross the $1 million barrier, coins that are in the 100,000 plus price range. there are many, many more of them than ever were existence before. And again, I think that's just a relative expression of the rate at which paper money is losing price value.
Yeah, I know that you and Andy used to go to a lot of these coin shows, or some. Do you still do that?
I have buyers now that do that because for a minimal amount, I can have people go through the process of spending the weekend at the show and doing the whole trip and the hotel room and then going to the auction and buying the coins. So I don't do that as much anymore. It's just become less necessary now in the modern world. It's a little bit easier for us to do this through a handful of heavy buyers that I work with extensively, and I get access to what they do without having to physically go, and it doesn't really cost me a lot of money to do that with them. So I save myself the time and effort and trouble of doing all the major shows, but we still do participate in an awful lot of them, some of the big auctions. And if I'm not there directly, I have people that represent us who are out there at these at the biggest shows. And they're about, I don't know, maybe a dozen what I would call major coin shows throughout the year. It starts in Florida with the United Numismatic Conference. We have shows in Chicago. We have shows in Long Beach. And these are big shows. I mean, tens of millions of dollars worth of coins trade hands over a weekend. Wow. And about everything that you'd want would be available, from the more generic to the really, really rare. And every time, we have one of these, there's information that comes about what was there and what wasn't. And, lately what's being gobbled up are a variety of things, but even the common generic gold coins, and by that I mean, let's say a standard American $20 gold coin, which is probably the most popular investment coin, that costs today between $2,600 and $3,000 a coin. They are being gobbled up by the investor market at the shows. So the dealers are going with lots of inventory, coming back with nothing, or they're going out to try to buy coins and finding there's just not a lot to purchase, because the amount of money coming into the industry has just absolutely exploded.
So there's a CPI report out that's a little bit cooler, according to Wall Street Journal. How could it be cooler if prices at where I shop keep going up and on everything? At the HEB in Dripping Springs, it doesn't look cooler to me, man. I don't know.
How do they do that?
How do they do that?
Yes. Pay no attention to the man behind the curtain. Yeah, so obviously the numbers are somewhat cooked, but what's happening is that inflation is not going down. It's just rising at a slower pace.
Rate. So
there is a difference. So it is still going up. It's just not going up as rapidly as it had been at the peak. And I accept that notion. I think we've seen the peak growth temporarily in the current inflation environment. It will continue to go up, but not quite as rapidly as it has been. And again, now parsing that, the traders will look at that and say, well, that's good news, because that translates to a Fed that will not have to raise rates quite as much going forward. People like that because they want to see the rate hike stop. But I don't think it's going to end anytime soon. I think the Fed is going to announce a rate hike next week, again, at the next meeting, because they have not beaten back the inflation beast yet. And their target to try to get inflation down to 2%, I think, is totally unrealistic. So
they really have a target, and they really believe in the 7% number, whether or not it's cooked or not. They just go with what their geeks put out, right?
And even based on their numbers, they're 5% over their target. So they have a long way to go to keep raising rates to get it down. So everything that comes out of Powell's mouth and every other Fed governor or Fed president has effectively been the same. They are fighting inflation, fighting inflation, fighting inflation. That's the target, more than stimulating economic growth. That'll come next, which will mean, again, they're simply going to reverse this process that they've just imparted on for the past 2 years, which to me is just ridiculous.
The whole thing seems cattywampus to me. I mean, couldn't you live with a higher inflation rate?
What was that word?
Cattywampus. Couldn't you live with a higher inflation rate, as you just said? You maybe their 2% is ridiculous, and keep things moving and jobs and people. And I mean, prices always go up a little bit anyway, don't they?
Sure. The problem becomes political, so you get a lot of pushback from people, and they start yelling at the politicians that somebody needs to do something because my costs are going up and I can't afford my life anymore. So help me, Mr. Politician. So the politicians get on the bandwagon and they start hammering at the Fed and saying, you guys need to, make this economy better for people. And obviously, I don't believe anybody thinks the government can do anything about this. So they're leaning on the Fed. If we can't politically attack the problem, we have to do it economically. How do we do that? We use the Fed. But the Fed only has a limited number of tools at its disposal. It's raising rates or lowering rates is pretty much everything it can do. There's not a lot else that the Fed can actually do. Again, it can do things within that realm. For example, it can raise the discount payments that it makes to banks to encourage more money that the banks held, or it can lower those rates to encourage the banks to be looser in their lending standards. It can buy bonds, it can sell bonds, it can manipulate stuff off of its balance sheet. Oh, speaking of, did you notice how had the Fed began to lower its balance sheet?
I did. I saw that.
Then the banking problem hit. And the next thing you know, they ended up buying a huge amount of treasuries to, again, add liquidity. And the balance sheet went right back up to where it was.
$9 trillion.
And I think right now we're probably pretty close to where we were at the top end. I mean, where were we? It was 8.9 trillion at the peak. I think we're at 8.7. I think at the last H4 release. I haven't looked at it in the last couple of days. But my point being that whatever progress they'd made in lowering their balance sheet was instantly reversed when the banking problem kicked in.
And so you understand this, Fred has taught us that the balance sheet is important because we know that the Federal Reserve Bank of New York creates dollars to buy stuff. I mean, that's how they do it. They monetize debt. And I've often asked Fred, well, what does it matter? What just maybe have 15 trillion on your balance sheet. And Fred talked to us about confidence, right? It's just about confidence. When the central bank has a balance sheet of 10 trillion, people out there know people in
no
the
one
money
else is buying this debt except the Fed.
Except the Fed. That's not good.
Not good. I mean, you don't want one customer for your company.
Yeah.
Right? You don't want a company that runs on one customer. What happens if that one customer fades away? You don't want a country have its currency supported by its central bank creating money out of thin air to buy treasuries from its treasury department to support the currency and have that be the only entity willing to hold government debt. You want that spread out around the world. You want everybody to want to hold your debt because this way no one entity holds any large enough quantity to affect the economy. And if it's left to the Fed and it's only the Fed, people begin to get somewhat suspicious about why no one else wants to hold U.S. dollars.
They start asking questions,
Sure.
They start asking questions.
But again, I keep looking at what the central banks are doing. They all seem to have looked at the current environment and concluded that going forward, their best bet is to buy gold. As opposed to even trying to strengthen their own internal currency. They've all just said, nah, I think our currency is going to be weaker. We better buy gold now in current dollars and stockpile it. But the volume of gold purchasing in central bank activity, it's 1,100 tons of gold has been purchased in the last 24 months. I mean, that's a huge volume of physical gold.
There's a bill out in Texas, and there are a bunch of people pushing for it. They want to do a state Texas digital thing backed by gold.
Sure.
That might be
I think
fun.
I think there are about 23 states that have all been looking into some form of a, metal-backed something, whether it be digital or currency. Again, why are they even venturing down that road?
You know why.
Right? What's wrong with the dollar? Well, obviously, I think they understand what's wrong with the dollar, and it's leading them to a point where they're willing to suggest other alternatives to walk away from their own country's currency.
I know.
That, talk about confidence.
Yeah.
This is my problem, is I think that worldwide, not just domestically, but worldwide, the value of the U.S. dollar right now is more predicated on what people think than the fundamentals of the dollar itself.
I believe that's right.
And again, that confidence is subject to erosion at a moment's notice.
Sure, and you have people like Macron out there, just in the wind, saying, well, we need to break away from the United States and all that. And people get nervous, with that stuff.
Yep.
Because they believe it. It's in the media, so they believe it. Yeah. And there's some interesting things going on with the retail outlets. You see where the dollar stores are really in a lot of trouble, and they're having all kinds of trouble with closing them. Whole Foods just closed the San Francisco store. Did you see that? Closed it down because it's so crazy out in San Francisco.
What is a dollar store now? Is it still $1 or is it $1.20?
I think it would be more like $90? A $5 store. And then I just
No,
saw.
but I mean, didn't they raise the price on everything? It used to actually literally be $1.
Oh, it used to years ago. But they have
I don't
thousands
think
of
it is
stores.
anymore.
But I just saw this article, which is interesting, and I wonder why. Subway is trying to sell their whole thing. It was now being valued at $7 billion, below the $10 billion that was originally looking for at auction. Wow, that's not good for Subway.
No. Well, there's slowdowns in the economy that you then have to account for when you try to look at the value of your company, right? So if automobile industry companies are looking at their value, they're looking at their sales. If the sales are down considerably, well, the value of the company is going to go down considerably. And so Subway is experiencing that. Although Subway seems to me to be a type of business that will be a little bit more resistant to a weaker economy. I mean, it's a very popular place for people to eat. It's, better quality food than a lot of places.
Yeah, it's not bad.
Still
It's
than
pretty
fast food. You know what I mean? As
Sure.
a general rule. But again, it's relatively inexpensive. It seems like it would be the kind of place that would still benefit even in a weaker economic environment. But everybody's going to be subject to economic slowdowns. And this is the problem I think the Fed has to face, is that they're getting two sides of the information coming to them. One, the inflation is not dissipating. Wage prices are still going up. Cost of goods are still going up. And yet they're beginning to see some slowdowns in some of the economic areas, which would indicate they should start lowering rates. How do you do both simultaneously? You can't raise rates to fight inflation and lower rates to create an economic activity to fight off a recession. You cannot do both simultaneously. The Fed is stuck in this middle ground
stuck in the middle with you.
And I think they're on the wrong side of the equation, because they're still, again, they've decided between this balance that they're leaning toward the inflation as the bigger problem than moving the economy forward. So they're more interested now in rates going up going forward to fight off inflation than to lower them to try to stimulate the economy, even if it's showing signs of slowdown. That's going to be a problem.
If you want to jump in before we go, and we're about to close out with Fred, Patrick at One Radio Network, here's an email from Gertie. My uncle passed away in December and left something in a trust for my sibling and I. His understanding and directive was for Fidelity to handle the distribution of the funds and trust. However, Fidelity has passed on the handling this, and my sibling is now recruiting a new trustee to review and allocating funds. Apparently, the reasoning is Fidelity felt there wasn't enough money to be worth their time. Is this typical? It seems to me on my uncle's end fairly clear his directive and understanding was Fidelity agreed to handle this. I have a perhaps paranoid suspicion that works events are what's causing them to stall. That what they're saying. Do you know anything about that?
Well, that's interesting. Obviously, there's going to be a legal contract that was signed when the trust was established, and whether or not that particular banking institution is obligated to sustain the trust probably came with a number of outs for the bank. I mean, I'm sure they left themselves with the ability to say, like they're alluding to, it's just not enough money for us to deal with. So we're going to set a minimum limit of X dollars. If you don't have that much, we're not going to control the account anymore, and you're going to have to get your own trustee. I haven't heard of that happening before necessarily, but I wouldn't be surprised if a number of the banking institutions just decided, to try to deal with larger quantities of capital and not have to do the work involved, but yeah. I would think that she probably has some flexibility there, and maybe it's an opportunity to get a better qualified person to manage the trust.
What are the benefits of trust in general? Just big picture?
The tax consequences, it's a way of transferring wealth between generations without the big tax hits. And for those people that accumulate a lot of wealth, trusts have always been a viable method of leaving money together and being able to direct how it is handled. Otherwise, you have things like probate that you have to go through with the states, and you have an awful lot of legal things to deal with when people pass and leave money for the family. A lot of that can be avoided with the use of trusts. There's some famous stories of the biggest bankers in history who've established trusts with their funds to prevent anybody from attacking capital. If, for example, a company gets sued, the trust is usually eliminated from the suit because it doesn't belong to anybody. It's set separately. So it was the famous story. I think it was Rockefeller had put his cat in a trust, and
I saw that.
the cat had attacked a neighbor, and somebody said they want to sue Rockefeller, and they said you can't. The cat is in a trust. All you could do is sue the trust, and the trust has only one asset in it. It's the cat. So if you sue the trust, the only thing you'll ever get is the cat. So there are definitely some interesting ways to use trusts to protect one's wealth, but generally that's the idea. It's either to make it much more viable and easy to transfer wealth between generations, and also to segregate funds from any kind of, let's say, attack from outside resources. If anybody should get sued for some other reason, any funds within the trust would be segregated and not, attached.
Well, it's going to be a fun year, Freddie. Tell folks about your company and what you do there, and how they should think about maybe trading some of their Federal Reserve notes for gold and silver. It's a good trade.
Well, I've been convinced for close to 40 years now that, the fundamental problem with paper money, which is it constantly loses purchasing power because it remains an unbacked currency, and that will be the continued way we will be operating going forward, that people should recognize that paper money is unrealistic to be a method of sustaining purchasing power over time. And diversifying has been a huge benefit for those people that have done it. No matter what economic environment we've had in the past 10 or 20 years, one thing that has stood out has become quite clear. Those people that were diversified did far better than people that were too overly weighted in any one market, whatever that market may have been. And it has shifted. At one point it was the stock market that was overvalued and it crashed. And at one point it was real estate and it crashed. And at one point it was money markets and they crashed. And at other points it was municipal funds. So there are always problems going forward. We can't anticipate. A perfect example, again, one show ago, we had not even had one word about a banking problem.
It was.
And yet we had a whole bunch of fundamental problems that already were recognizable enough to where it made sense for people even then to say, hey, we should diversify and own some physical gold and silver. Going forward from here, all I can say is, again, I will reiterate, my growing concern is that the size of problems that come up as we move forward in time now tend to be so much larger, that their impact is so much greater, and they pose a greater risk to people going forward, more so than any other time in our history, being in this industry, that I am absolutely convinced people should be diversifying their wealth. Anybody who's sitting on any large amounts of money within the banking system at this point has got to see what's been happening. The purchasing power of their money is eroding rapidly. So they should own physical gold and silver coins and do that now. Get possession, have them locked up in your particular own hands, and then you have that protection of your wealth, and it'll be a lot safer going forward. It'll be a lot more sustainable in purchasing power going forward. It'll create a lot of peace of mind. It'll really ease people's concerns about all the volatility in the economy. And then as things occurred, people will be able to say, well, at least I have that physical gold and silver representing a portion of my wealth. I'm not exposed 100% to the paper world. Yeah. And I am absolutely convinced that there's never been a better time for people to do this than what we're experiencing right now.
Fred's telephone number is 800-878-2646. He has a team there, and talk to anyone, 800-878-2646. But people can talk to you if they want to and ask for you? Absolutely. Absolutely. And who knows, Zelensky keeps knocking on Janet Yellen's door, every night saying, I want more money. So who knows how much more money they're going to print. Sure. This Ukraine war doesn't look like it's going to go away.
Not like any other war has ever gone away, right? Yeah. Again, the Iraq war was supposed to be $1 billion expense.
Yeah, right.
Remember that?
Yeah. Oh, yeah.
It was supposed to be $1 billion. It was 11 trillion by the time we were done. So, the fact that we're going to keep bleeding money for anything that comes up, whether it be legitimate or not. And I'm not suggesting that all these things aren't, necessary, even if we accept the notion that they're correct, or, that we have an obligation morally to say we're going to support Ukraine because we think what is being done is wrong on a moral basis, right? So we're going to support you. But again, people have been making this argument for decades that government needs to decide where is the relevant value of capital expenditure. Is it to support Americans and our economy, or is it to play policeman around the world and try to solve all the problems worldwide because we think we're morally obligated to do so? I don't think we can afford to do it, but we do live in an integrated world. It's kind of hard to be, as George Washington would have wanted, an isolated America. You just can't exist like that anymore. It's a global economy. So with that comes an awful lot of other obligations that we may have to face going forward. And all I can say is you just never know what's going to happen next, right? I mean, last month, again, we haven't even had the first bank failure. So who knows what we'll be talking about next
week. A final one just popped in from Amy. I work in a college town, and I'm often astounded at how cheap and financially uninformed many academics are. I've thought that there could be a stronger connection between intelligence and financial knowledge. Has Fred seen this connection too?
Sure. Yeah. I used to call it the dumbing down of America. So I remember having a conversation with a man named Eustace Mullins, who authored a number of incredible books. The most powerful one was Secrets of the Federal Reserve. We were talking about this in the 1980s, that there was a correlation between the level of education in America and the value of money. That there was an absolute correlation between the two. Now, there's no causation there. There's merely correlation. However, we were looking at a chart of the dollar and its purchasing power and the relative knowledge of average Americans over a period of decades. And as the American average intelligence kept dropping, so was the value of the dollar, and they were actually parallel. So there was a study that was done, and it was probably now 15 years ago, and I'm sure it's more than true now. But the point of the study was that the education level of what used to be high school, what people knew when they graduated high school, was now the equivalent of what people knew when they graduated college. So those that didn't attend college didn't even have the basic knowledge that those in the 1960s and 70s had gained just from attending high school. And of course, I've seen the recent studies of what people know, those men on the street interviews.
Yeah, amazing.
I mean, they got to make you laugh, but they're so disheartening when they stop 20 and 30-year-olds and they ask them things like, what country is Mount Rushmore in? And they can't tell you. Who did we battle against in the Revolutionary War? Who did we gain our independence from? They can't tell you. People who cannot find New York on a map, don't know where China is.
I've seen some of those interviews. It's like crazy. It's like, what?
It is crazy, and yet they're real. And it's just amazing the lack of basic information that just doesn't seem to exist anymore. I don't know how that happened. I don't know whether it's like we're going to argue the educational system was, whether they did it on purpose, whether this was an overall plan of the dumbing down of America, because, listen, you don't want, as George Carlin used to say, the last thing you want is an intelligent, free-thinking public. Right. You don't want that.
No.
You want anything but that. So, yeah, I find it very interesting that, the more that I age, the more I find a huge gap in what I used to know when I graduated high school, comparatively to what people who are walking around America today just don't even understand. And I just don't get it.
I would argue that those that followed Andy and now you, when you and Andy for the last 15 years know more about the world of money than a master's in finance or something from a college. I understand the basics more. I don't know.
Well, that I can get. All right. So it's a more of a finite, area of knowledge. Okay. I don't expect that most Americans are going to understand the nature of the Federal Reserve or how the Open Market Committee works or what an interest rate hike means to the economy or how the Fed manipulates lowering or raising rates and what impact that has, how the Treasury Department functions, how money circulates around the country. You wouldn't expect that average person to necessarily get that, but some basic information seems to be, necessary. And I don't know how they don't teach this stuff in school, the idea of, what establishes the value of a dollar or how, general banking works. But yeah, it's pretty disheartening. And I know that the Federal Reserve board chairman and all the Fed governors They're all educated with PhDs from basically the same school of thought, which is, I think, what leads to some of the problems, is why they don't necessarily see the world the way other people do, because they've been taught that this is how things work. Everything comes from, supply and demand, and everything is based upon, let's focus on the demand side first, as opposed to the supply side. That changes the mindset, but that's not something a PhD in economics is going to do, because he's been taught, the Keynesian method of economics, and that's what they understand. I came at this as a, tabula rasa. So I started with nothing.
As a who? As
a blank slate.
A blank slate.
Tabula rasa, yes. A blank slate. I didn't come in with any pre-existing notions. I came in trying to understand a fundamental problem that I had. It was just a mental problem. I could not understand how we had a constitutional word that said, no state shall make anything but gold and silver coin a tender for payment of debt. How do we have that still existing in the Constitution of the United States? There's never been a Supreme Court decision that has overturned that, yet we have money in America. It's not backed by gold and silver. How do these two things work together? I could not get that in my head. I couldn't figure it out.
That's what started you out, right?
That's what started me down the trail.
That's great.
It was that just weird kind of, these two things can't both exist. How do they exist simultaneously? I don't get it. And it sent me down a path that led me to understand, my God, the manipulation of money was like this massive, massive thing in the U.S., and it affected everyone's wealth, and it was completely out of the control of the public. And then I went back and looked at what the founding fathers had done, simple things like the first bank charters of the United States, which would have been the equivalent of a central bank then. We didn't have a central bank per se at that moment. We had a bank charter that was granted to authorize this particular institution to be the Bank of the U.S.
It's the first Bank of the United States, right? 1790.
First Bank of the United States, 1792 to 1812. Yeah. But here was the hook. They were only given a 20-year charter.
Yep.
And the reason was because they wanted to have an opportunity to look at 20 years later and say, how did they do?
Right.
Did they do their job? As if we could say to the Federal Reserve, okay, we established you in 1913. Let's go out 20 years. Now it's 1933. How have you done? And if you're not doing a good job, guess what? We're not renewing your charter. You no longer exist. We're going to create a new institution, give them this new authority, let them run the game for a while, see how they do. And we've moved away from that, because what we did with the Federal Reserve is pretty much gave them an open-ended window.
Perpetual charter.
That's it.
And the Fed, of course, is private. It's so interesting when you look at 1792, 20 years later, 1812, and that's what the War of 1812 was about, many people argue.
Big pushback against the renewing that second charter. And then when Andrew Jackson became president after the second charter expired, he recognized the problem.
Yeah.
And he was actually running his presidential campaign on the idea that, look, if you elect me, I will throw these bastard bankers out and reestablish the banking system the way it was supposed to be back in the 1790s.
He did, right?
And he did. He had to fire 1, 2, 3, 4, I think there were like 7 Treasury secretaries, because every time he would put a Treasury secretary in authority and then tell him, do not reestablish the charter, the Treasury Secretary was getting pressure from European bankers, and they wanted to do it. And he said no. So he fired him, and he put another guy in his place. He wouldn't do it either. He fired him and put another. 7 down the line, he finally found a guy with the balls to say, okay, I'm with you, and we're not going to renew this charter. And then from 1837 forward, if you look at what happened in America up to the Civil War, we had one of the greatest expansions of monetary value in America in U.S. history.
Wow.
It was a great period of growth for the U.S. Yeah. Had it not been for the interruption of the Civil War, that probably would have continued for another 2 or 3 decades.
And for his efforts, as you know, they took a couple pot shots at old Jackson too.
Yeah, well, he was a kind of an arrogant sort of guy. It's not like he was the most pleasant president, but anyway, he did stand for some really great things, and one of those being this fundamental understanding of why we had bank charters that were only granted 20-year status.
Yeah.
Again, had it not been for the Civil War, we might still have that, a bank charter system where after every 20 years, we got to either renew or not. I wish we had that, because wouldn't it be great if we could turn around to the Federal Reserve and say, here we are 120 years later, and guess what? you guys have reduced the value of money from the day you took over in 1913 to now in 2023. The original value of $1 is now worth about 2.5 cents.
Yeah. And even in 1980, if I remember with the shows from Andy, he used to say there was only $1 trillion in the money supply in 1980. I mean, what's up with that? So in, 40 years, or what, it was 1982?
Yeah, believe it or not, that's 40 years now.
40 years, and there must be, we don't even know the number now, Fred, do we?
It's 30 plus. But I'll tell you what's funny. I was watching an old TV program, not that old. It's called Boston Legal.
Oh, yeah.
It was with James Spader and William Shatner. It's a funny legal program.
Sure.
I don't know how dated it is. I know it was, I want to say it was the 90s, but I think so. I think it was in the 2000s because they do make references to 9/11. So I think it has to be in the 2000s. But at one point, they're having a legal argument. And they raised the issue that, oh my God, the country is $9.4 trillion worth of debt. How can we possibly continue and sustain this? And they're arguing and freaking out about the fact that the government was $9.4 trillion in debt at that moment. And I just started laughing about that. I was like, oh my God, if they only knew where we would be now with $31 trillion worth of debt.
Well, even that, I don't buy that 31 because that thing hasn't moved hardly.
Only the bonded debt, right?
Yeah, that even the bonded debt's got to be more than 31, hasn't it? I mean, look at the.
I think that's fairly accurate because that's only the Treasury bonds and stuff that we can actually count accurately.
But it hasn't moved up though in the last 4 or 5 years, and all the money being. A lot of the Fed has bought a lot of these treasuries. Why isn't that number bigger? I don't get that.
Remember now, every time the Fed moves stuff onto its balance sheet, it's sort of, it disappears
smoke
a little
and
bit.
Mirrors. Yeah, smoke and mirrors.
Yeah, they're gimmicking the game, but we know that real numbers are astronomical. I mean, between Medicaid, Social Security, and the bonded debt, we're over 100 trillion in actual debt.
Actual debt, everything. Yeah.
And even Jerome Powell says that is unsustainable.
You think? I mean, how are you going to pay off $100 trillion?
There's no government way to do it. So the only way to do it is print money. Yeah. So if they're going to print their way out of that problem over the next decade, I think I've said this before, if not, we will be 50 trillion in debt within the next decade. The number's going to be, you and I hopefully we're still talking then, we're talking $50 trillion.
And the interest on the yearly interest on our debt today is about 1.5 trillion, isn't it? In that range. Wow. A yearly interest that we, the people, pay on this debt.
Which we barely can afford it. Barely. Oh, and by the way, we've run out of money. So if the government doesn't raise the debt limit within the next 2 months, we're going to have another one of these real economic. And I'll tell you what, my biggest concern about the dollar going forward is going to be the credit rating agencies. If they should alter the credit rating on the U.S. dollar, we are doomed for a disaster in the dollar's value. If we get to that point where Congress starts screwing around and plays chicken with this debt limit, I mean, I don't think politically they would have the guts to do it. But even if they get to the point where it gets critical, the credit agencies can turn around and just say, hey, we think the dollar's very disconcerting at these levels, and we're going to drop it from AAA to AA or lower. And let me tell you something, if the credit rating agencies begin to reduce their level of rating on the dollar, we are in serious trouble. Gold, silver prices would skyrocket, and the dollar's purchasing power would implode. So I hope Congress gets its act together quickly. Janet Yellen bought us till about the end of June, July. I think the latest I've heard is perhaps the first week of August. We've manipulated money by not making payments to certain accounts. We've stopped funding dozens of pension accounts already and just told these people that we will hopefully make it up to them when Congress goes ahead and raises the debt limit. So Congress has to do that. There is no choice because this is not future spending we're talking about. This is money we've already spent. These are checks the government wrote that are floating around already and about to come back to the bank. And we need the funds in there to make the checks good. In order to do that, they have to raise the debt limit. So this is money the government's already spent. They can't turn around and say, well, we just don't want to pay that. It's too late. But if they don't make good on these payments, that obligation is going to filter down through the economy where people begin to question the government's ability to make good on its debt instruments. It's game over.
Well, Mr. Fred, we have to make way for another show coming up in about 12 minutes. And boy, we stayed a long time with you. If you think these people are crackers and they're not going to turn into real people, just call Fred at 800-878-2646. Crackers.
That's us.
That's us. Thanks, Fred, for being here. We really appreciate it. Have fun. Say hi to Stan.
Always a pleasure, Patrick.
Okay,
Great
brother.
to see you. Stay healthy and
Take
happy.
care.
We'll see you soon.
Thanks for your support. Fred Dashevsky, Patrick Timpone, OneRadioNetwork.com. We're going to make way for Veras Ahmad. He's a cool guy, and we're going to talk about all the fun subjects when it comes to proteins and carbs and fats and whatever. Keto, carnivore, I don't know. He's a cool guy, and he's coming up. So I got to take a little break here, and we will see you in 12 minutes. So don't go far.
Broadcasting from the beautiful Hill Country in Texas, this is OneRadioNetwork.com.